You've done everything right. You've studied the market, analyzed the patterns, built a strategy that should work, and it does work, at least on paper. But somehow, you're still losing. Your account balance keeps shrinking while other traders with seemingly worse strategies are making profits. You lie awake at night replaying your trades, searching for the flaw in your system, convinced that if you just tweak one more variable, everything will click into place. But here's what nobody tells you. The problem isn't your strategy at all. What's destroying your results is invisible, operating beneath your conscious awareness, and it's so deeply embedded in human psychology that even knowing about it doesn't make you immune. This is the paradox that separates consistently profitable traders from everyone else, and understanding it will completely transform how you approach every single decision you make in the markets. Let me share something that happened to me 3 years ago that perfectly illustrates this phenomenon. I had developed a trading strategy that back-tested beautifully across 5 years of historical data. The win rate was solid at 62%, the risk-to-reward ratio was excellent, and the drawdown periods were manageable. I paper traded it for 2 months, and the results matched my backtest almost perfectly. I was convinced I had found something special, something that would finally give me the consistent edge I'd been searching for. So I went live with real money, following my rules exactly as I'd written them. Within 6 weeks, I had lost 18% of my account, even though my strategy was still statistically performing within expected parameters. I was devastated, confused, and ready to abandon trading altogether. But then I discovered something that changed everything, and it had nothing to do with improving my strategy. The realization came when I started journaling not just my trades, but my emotional state during each decision. What I found was shocking. Even though I believed I was following my strategy perfectly, I was actually making dozens of micro-adjustments based on recent results. After 3 winning trades, I would unconsciously start taking larger position sizes because I felt confident and invincible. After 2 losing trades, I would skip valid setups because I was afraid of another loss, or I would exit winners too early to secure quick profits and rebuild my emotional state. I would hold losing trades longer than my rules allowed because I didn't want to accept another loss after a string of them. These weren't conscious decisions. I genuinely believed I was following my plan. But the data in my journal revealed a completely different story, one where my emotions were the actual trading system and my carefully crafted strategy was just window dressing. This is what psychologists call the implementation gap, and it's the silent killer of trading accounts everywhere. Your strategy might have a positive expected value, but if you only execute it properly 70% of the time, that positive edge evaporates. Think about it mathematically for a moment. If your strategy wins 60% of the time with proper execution, but you only execute it properly 70% of the time, your actual win rate drops significantly. But it gets worse because the trades where you deviate from your strategy aren't random. They're systematically biased. You're most likely to deviate after losses, when your fear is highest, which means you're skipping the trades that would help you recover. You're most likely to overtrade or increase position size after wins, which means you're taking maximum risk precisely when you're feeling most confident and least analytical. Your emotional deviations aren't just noise, they're perfectly designed to destroy your edge. The financial markets are a unique environment because they provide immediate, visceral feedback on your decisions, and that feedback is denominated in the one thing humans care most about: money. When you lose money, your brain doesn't process it as abstract information. Your amygdala, the primitive part of your brain responsible for survival, interprets financial loss as a physical threat. Your body releases cortisol and adrenaline, the same stress hormones that would flood your system if you encountered a predator. This isn't a bug in human psychology. It's a feature that kept our ancestors alive. The problem is that the same emotional system that helped humans survive for millions of years becomes a liability in trading, where the correct action often feels completely wrong in the moment. Cutting a losing trade feels like accepting defeat. Holding a winning trade while it pulls back feels like watching money slip through your fingers. Taking the next setup after 3 consecutive losses feels like throwing good money after bad. Your strategy might be telling you to do one thing, but your entire evolutionary biology is screaming at you to do the opposite. Here's where it gets even more interesting. Most traders, when they start losing despite having a good strategy, make the problem worse by trying to fix the strategy. They assume the issue is technical. Maybe the indicators need adjustment. Maybe the time frame is wrong. Maybe they need more filters to improve the win rate. So they start tinkering, optimizing, curve-fitting their strategy to recent data. This feels productive because they're taking action, doing something to address the problem. But what they're actually doing is destroying whatever edge their original strategy had. They're chasing the mirage of the perfect system that never requires them to experience discomfort, fear, or uncertainty. That system doesn't exist. Every profitable strategy in the world requires you to execute trades that feel wrong in the moment. Every edge in the markets comes from doing what's uncomfortable when everyone else is doing what feels safe. The traders who succeed long-term aren't the ones with the best strategies. They're the ones who can execute a mediocre strategy with perfect consistency. Think about that for a moment, because it contradicts everything the trading industry tells you. You've been sold the idea that success comes from finding the secret indicator, the perfect entry pattern, the optimal risk-reward ratio. But the reality is that dozens of different strategies can be profitable if executed with discipline. The edge isn't in the system, it's in the execution. A trader who can follow a simple moving average crossover system with perfect discipline will outperform a trader with a sophisticated machine learning algorithm who can't control their emotions. The consistency of execution is more valuable than the sophistication of the strategy. This explains why you see traders with completely different approaches all making money in the same markets. One trader might be a trend follower who holds positions for months. Another might be a mean reversion scalper who's in and out in minutes, and yet both can be consistently profitable. They're not winning because they've discovered the one true way to trade. They're winning because they've mastered the psychology of execution. They've learned to do what their strategy demands regardless of how it feels in the moment. They've built systems that remove emotional decision-making from the process. They understand that their job isn't to predict the market or to be right. Their job is to execute their edge repeatedly, even when recent results make them want to deviate. Let me give you a concrete example of how this plays out in real trading. Imagine you have a breakout strategy that enters when price breaks above a key resistance level. The strategy has you place your stop loss below the breakout point and target a reward that's 3 times your risk. Based on your testing, this setup wins 45% of the time, which gives you a positive expected value. Now let's say you take 5 trades and all 5 are losers, even though they were all valid setups according to your rules. This is completely possible and actually likely to happen periodically, even with a working strategy. But here's what happens psychologically. After 5 losses, you're in pain. You're doubting yourself and your strategy. You're afraid of another loss. So when the 6th valid setup appears, you either skip it entirely or you enter but move your stop loss further away to reduce the chance of being stopped out again. Or you take a smaller position size to minimize the pain if you lose. All of these deviations feel rational in the moment. You're protecting yourself from further damage. But mathematically, you're destroying your edge. That 6th trade might have been the winner that started your recovery, but you weren't there for it. Or you took it with the wrong position size. Or you moved your stop and turned what should have been a small loss into a larger one. The cruel irony is that the more you care about individual results, the worse your overall results become. Your emotional investment in each trade creates the very volatility in execution that destroys your edge. Traders who treat each trade as just another iteration of their statistical edge, completely detached from the individual outcome, are the ones who achieve consistency. But how do you actually do that when real money is on the line? How do you train yourself to be indifferent to outcomes when your account balance represents your financial security, your self-worth, your validation that you're capable of succeeding at this incredibly difficult skill? This is the central challenge of trading, and it's not solved by finding a better strategy. It's solved by fundamentally rewiring how you relate to risk, uncertainty, and the meaning you attach to individual outcomes. The answer lies in understanding something that most traders never grasp until they've blown up multiple accounts and spent years in the wilderness of inconsistent results. Your brain is running two completely different operating systems simultaneously, and they're in constant conflict with each other. The first system is rational, analytical, and strategic. This is the part of you that developed your trading plan, back-tested your strategy, and understands probability theory. The second system is emotional, reactive, and designed for immediate survival. This is the part that takes over when you're actually clicking the buttons and watching your money fluctuate in real time. The tragedy is that most traders spend 95% of their preparation time strengthening the first system while completely ignoring the second. And then they're shocked when the second system hijacks their behavior during live trading. You can have a PhD in market analysis and still make beginner mistakes when your emotions take control, because knowledge and emotional regulation are completely different skills that live in different parts of your brain. What makes this even more insidious is that your emotional system learns from experience, but it learns the wrong lessons. Every time you deviate from your strategy and avoid a loss, your brain registers that as a success. Let's say you skip a valid trade setup because you're afraid after recent losses, and that trade ends up being a loser. Your emotional brain just learned that fear kept you safe, even though statistically you needed to take that trade as part of your overall edge. The next time a similar situation arises, your fear response will be even stronger because it's been reinforced. Conversely, every time you follow your strategy and take a loss, your emotional brain registers that as punishment for following the rules. Over time, through this twisted learning process, your subconscious mind becomes convinced that following your strategy is dangerous and deviating from it is safe. You're literally training yourself to fail, one trade at a time, through a process that feels like you're being careful and protecting yourself. This creates what I call the spiral of competence confusion, where your actual trading skill diverges further and further from your perceived trading skill. You study charts for hours, you understand market structure, you can identify perfect setups in hindsight, and you genuinely believe you're a knowledgeable trader. But your execution tells a different story. You're making decisions based on recent results rather than strategy rules. You're adjusting position sizes based on emotional state rather than account risk parameters. You're exiting trades based on fear rather than predetermined targets or stops. The gap between what you know you should do and what you actually do becomes a chasm, and every day that chasm grows wider because you're practicing the wrong behaviors. You're getting better and better at emotional trading while your strategy sits unused, like a gym membership you pay for but never use. The most dangerous part is that you can maintain the illusion that you're following your strategy because you're using the same indicators and looking at the same setups, but the actual decision-making process has been completely hijacked by your emotional state. Now here's where most trading psychology advice fails you completely. You've probably heard all the standard recommendations: meditate before trading, use proper position sizing, keep a trading journal, follow your rules, stay disciplined. This advice isn't wrong, but it's like telling someone with a broken leg to walk properly. The instruction is accurate but useless without addressing the underlying injury. Your underlying injury is that you haven't built the psychological infrastructure that makes consistent execution possible. You're trying to impose discipline through willpower, and willpower is a finite resource that depletes throughout the day. Every time you force yourself to follow your rules when your emotions want to do something else, you're spending willpower. Eventually, that resource runs out, and when it does, your emotional system takes full control. This is why you can trade perfectly for a week and then have one day where you completely fall apart and give back all your gains. You ran out of willpower, and without it, all your preparation becomes useless. The solution isn't to develop more willpower or to try harder to control your emotions. The solution is to build systems that remove the need for willpower entirely. Think about the best traders you know or have studied. They're not succeeding because they have superhuman discipline. They're succeeding because they've automated the parts of trading that most people struggle with. They've created pre-trade routines that ensure they only see valid setups. They've built position sizing calculators that remove the temptation to risk more when they're feeling confident. They've set hard rules about when they're allowed to trade and when they must step away. They've turned trading from a series of emotional decisions into a mechanical process that can be executed regardless of emotional state. This isn't about becoming a robot. It's about recognizing that your emotions are terrible advisors during moments of financial stress and building systems that protect you from your own psychological vulnerabilities. Let me give you a specific example of how this works in practice. One of the most common ways traders sabotage themselves is through revenge trading. You take a loss, maybe even a series of losses, and you feel an overwhelming urge to make the money back immediately. This urge is so strong that you start taking trades that don't match your strategy, increasing position sizes, or entering markets you don't understand. Your rational mind knows this is destructive, but your emotional mind is in control, and it's screaming that you need to recover those losses right now. A willpower-based approach to this problem would be to simply tell yourself not to revenge trade, to breathe deeply and calm down. Sometimes this works, but often it doesn't, especially if you're in a heightened emotional state. A systems-based approach looks completely different. You create a rule that after any loss, you must close your trading platform and walk away for a minimum of 30 minutes. You set up your trading software to automatically limit your daily loss to a specific amount, after which it locks you out. You create a pre-trade checklist that includes verifying you're emotionally neutral before entering any position. These systems don't require willpower because they're automated barriers that protect you from yourself. You can feel the urge to revenge trade all you want, but the systems prevent you from acting on it. This is where the truly successful traders separate themselves from everyone else. They've accepted that they can't control their emotions, so they've stopped trying. Instead, they've controlled their environment and their processes to make emotional trading impossible. They trade during specific hours and literally cannot access their accounts outside those times. They use order types that automatically execute their exits, so they can't be tempted to hold losers or cut winners short. They keep a photograph of their family or their financial goals visible while trading, so that every decision is contextualized within their larger life purpose. They've built what psychologists call an external locus of control, where the structure around them dictates behavior rather than relying on internal willpower. This isn't weakness. This is wisdom. It's the recognition that trading is hard enough without also having to battle your own psychology in real time. But even with perfect systems, there's another layer to this problem that most traders never address. Your strategy might be working exactly as designed, producing the expected win rate and average returns, but you're still losing because your expectations are completely disconnected from reality. You've been sold a fantasy version of trading where consistent profitability means smooth, predictable growth with manageable drawdowns. The reality is that even the best strategies go through periods of significant drawdown that can last weeks or months. Even the most profitable traders have losing streaks that would make most people quit. The difference is that they understand this is normal, expected, and built into their model. When you don't have this understanding, every drawdown feels like failure. Every losing streak feels like your strategy is broken, and you start making changes at precisely the wrong time. You abandon strategies during their drawdown periods, right before they would have recovered. You switch approaches after a string of losses, which means you're always starting over, and never giving any single approach enough time to play out its statistical edge. This is compounded by what's called recency bias, where your brain gives disproportionate weight to recent experiences over long-term data. If your last 5 trades were losers, your brain becomes convinced that your strategy doesn't work, even if your last 100 trades show a clear, positive edge. If your last 3 trades were winners, your brain becomes overconfident even if you're statistically due for a normal losing period. You're constantly reacting to noise instead of signal, making decisions based on the least relevant data. Professional traders understand that the last 5 trades mean almost nothing. They're focused on the last 500 trades, or even 5,000. They know that short-term results are essentially random and that their edge only manifests over large sample sizes. But this level of statistical thinking doesn't come naturally to humans. We're pattern recognition machines that see meaning in randomness and causation in coincidence. We want to believe that every win means we did something right and every loss means we did something wrong, when often the truth is that we executed our strategy correctly and the outcome was just part of normal statistical variance. Here's a thought experiment that illustrates this perfectly. Imagine you have a coin that's weighted to land on heads 60% of the time. If you flip this coin 10 times, you might get 7 heads, or you might get 4 heads. Neither outcome tells you much about whether the coin actually has a 60% edge. You need to flip it hundreds of times before the true probability reveals itself. Trading is exactly the same. Your strategy might have a genuine edge, but you won't see it in 10 trades, or even 50 trades. You need a large enough sample size for the statistics to overcome the randomness. But most traders never get to that sample size because they abandon their approach after a statistically normal losing streak. They're constantly searching for the perfect strategy instead of giving any strategy enough time to prove itself. This is why strategy hopping is one of the most common patterns among struggling traders. They collect dozens of approaches, each one abandoned after the first significant drawdown, never realizing that they're stopping right before their edge would have materialized. The financial markets are essentially a mechanism for transferring money from people who can't handle psychological uncertainty to people who can. Every edge in trading comes from exploiting predictable human behavior patterns: fear, greed, recency bias, loss aversion, confirmation bias. When you trade emotionally, you're not just failing to execute your strategy, you're literally becoming the liquidity that makes other traders profitable. You're buying at tops because fear of missing out overwhelms your discipline. You're selling at bottoms because fear of further losses overwhelms your strategy. You're providing the exact counterparty that profitable traders need to enter and exit their positions. The market doesn't care about your strategy or your analysis. It only cares whether you can execute consistently under psychological pressure. This is why trading is often described as the most expensive form of self-discovery. Every mistake costs you real money, and the lessons you need to learn are all about yourself, not about the markets. The transformation from inconsistent to consistent trader requires something that nobody wants to hear. You have to fundamentally change your relationship with being wrong. Most people enter trading with their self-worth tied to their accuracy, treating every losing trade as evidence of personal failure and every winning trade as validation of their intelligence. This psychological framework makes consistent execution impossible because you're essentially asking yourself to repeatedly engage in an activity that feels like it's attacking your identity. Every loss becomes personal. Every drawdown becomes a referendum on your worth as a trader and possibly as a person. You can't execute a strategy properly when following it feels like volunteering for psychological damage. The traders who make it through this crucible emerge with a completely different mindset. They view losses as the cost of doing business, no different from a retail store paying rent or a restaurant buying ingredients. The losses aren't failures, they're overhead expenses that are necessary to capture the wins that make the entire operation profitable. This shift sounds simple when described in words, but achieving it requires you to confront some of the deepest psychological patterns you carry. For most people, being wrong triggers shame, a primal emotion connected to social rejection and survival. In our ancestral environment, being wrong about important decisions could get you expelled from your tribe, which was essentially a death sentence. Your brain still carries this ancient wiring, which is why losing money in trading can feel so devastating even when the amount is objectively small. You're not just losing currency, you're triggering ancestral fears about competence, belonging, and survival. The path forward requires you to consciously separate your trading results from your identity, to build what psychologists call ego resilience, where your core sense of self remains stable regardless of external outcomes. This doesn't mean you stop caring about results. It means you stop using results as the measure of your worth. You start measuring yourself by process adherence instead of outcomes, by whether you followed your strategy rather than whether the trade made money. One of the most powerful techniques for building this psychological foundation is what I call outcome blindness training. For a full month, you execute your strategy while deliberately not calculating your profit and loss. You take your setups, manage your trades according to your rules, and record whether you followed your process correctly, but you don't look at how much money you made or lost. This sounds impossible to most traders because they're addicted to the immediate feedback of results. But that addiction is precisely what's destroying their consistency. By training yourself to focus exclusively on process, you begin to rewire your brain's reward system. Instead of getting a dopamine hit from a winning trade and a cortisol spike from a losing trade, you get satisfaction from executing your plan correctly. Your emotional state becomes stable because it's no longer tied to outcomes you can't control. After a month of this practice, when you finally look at your results, something remarkable happens. You usually find that your performance improved significantly because you were making decisions based on strategy rather than emotions. You were no longer cutting winners short to secure the emotional relief of a quick profit. You were no longer holding losers hoping they'd come back. You were simply executing your edge, trade after trade, without the emotional interference that usually sabotages your results. Another critical element that struggling traders miss is the importance of environmental design in trading success. Your trading environment should be engineered to support optimal decision-making, but most traders give this no thought whatsoever. They trade from their bedroom with their phone buzzing notifications, their television playing news in the background, and their mind scattered across a dozen different concerns. They wonder why they can't maintain focus and discipline when they've created an environment that makes focus impossible. Professional traders treat their trading space like surgeons treat an operating room. It's a controlled environment designed for a specific high-stakes task. There are no distractions, no sources of emotional volatility, and no reminders of anything except the process they're executing. Some traders go so far as to have a separate computer used only for trading, in a room used only for trading, during hours dedicated only to trading. This physical separation creates psychological separation, making it easier to enter the mental state where consistent execution becomes natural. When you sit down in that space during those hours, your brain knows exactly what's expected, and you've eliminated the 1,000 small decisions and distractions that normally deplete your willpower throughout the day. The role of physical state in trading performance is also vastly underestimated by most traders. You're essentially asking your brain to make rapid decisions under uncertainty while managing complex emotions, and you're trying to do this while sleep-deprived, caffeinated to the point of anxiety, sitting in a posture that restricts blood flow and eating foods that create blood sugar crashes. Your brain is a physical organ that requires specific conditions to function optimally. and trading is demanding enough without handicapping yourself with poor physical state. The most consistent traders I know treat their physical preparation as seriously as their market analysis. They have regular sleep schedules that ensure they're rested before trading. They exercise regularly because physical activity regulates the stress hormones that interfere with clear thinking. They eat stable meals before trading sessions to avoid blood sugar fluctuations that affect decision-making. They take regular breaks during trading to prevent decision fatigue. These might sound like minor factors compared to having the right strategy, but they're often the difference between executing your strategy properly and falling into emotional patterns that destroy your edge. There's also a timing element to trading psychology that most people never consider. Your ability to execute consistently isn't constant throughout the day or week. It fluctuates based on your mental state, which is influenced by dozens of factors including sleep, stress, recent experiences, and even blood sugar levels. Most traders try to trade whenever their strategy produces signals, regardless of their psychological state, and then they wonder why their results are so inconsistent. A more sophisticated approach is to only trade during your peak mental hours, when you're rested, focused, and emotionally stable. For many people, this is the first few hours after waking up, before the stress and decision fatigue of the day have accumulated. For others, it might be late morning or early afternoon. The specific timing matters less than the recognition that you need to identify when you're psychologically at your best and restrict your trading to those windows. This means you'll miss some valid setups that occur outside your trading hours, but that's irrelevant. The goal isn't to catch every opportunity. The goal is to execute your edge consistently, and you can only do that when you're in the right mental state. Missing opportunities while in a poor mental state is infinitely better than taking trades while in a poor mental state, because the former costs you nothing, while the latter actively destroys your account. Let's talk about something that's rarely discussed in trading education, but is absolutely crucial: the concept of psychological position sizing. Most traders learn about position sizing in terms of risk management. Don't risk more than 1 or 2% of your account on any single trade. This is important, but there's another dimension to position sizing that's equally critical. You need to size your positions based not just on your account size, but on your psychological capacity to handle the volatility. If you're risking an amount that makes you anxious and causes you to micromanage the trade, your position is too large regardless of what the risk management formula says. The correct position size is the one that allows you to execute your strategy without emotional interference. For some traders, especially when they're beginning or working through psychological issues, this might mean risking 0.5% or even less per trade. The goal is to reach a state where you can watch your trade move against you without feeling the urge to exit prematurely, and where you can watch it move in your favor without feeling the urge to take profits early. When you've found the position size that creates this emotional neutrality, you've found your psychological position size. As you develop more psychological resilience, that size can gradually increase, but you should always be trading at a size that allows for optimal decision-making rather than maximum profit potential. The concept of process goals versus outcome goals represents another fundamental shift that separates consistent traders from strugglers. Most traders set outcome goals: make $10,000 this month, achieve a certain percentage return, reach a specific account size. These goals are completely outside your control because you can't control what the market does. You can execute your strategy perfectly and still have a losing month because the market conditions didn't favor your approach. When your goals are outcome-based, you're setting yourself up for psychological distress because you're measuring yourself against something you can't control. Process goals are completely different. They're things like: execute 20 trades this month following my strategy perfectly, maintain my pre-trade checklist completion rate at 100%, keep my average time in losing trades below my average time in winning trades. These goals are entirely within your control. You can achieve them regardless of what the market does, and achieving them is what actually creates long-term profitability. When you shift to process goals, something remarkable happens. You start feeling successful even during losing periods because you're measuring yourself against the right metrics. This success feeling keeps you motivated and consistent, which is what ultimately produces the outcome results you want. The outcome becomes a side effect of process excellence rather than the direct target of your efforts. Many traders also underestimate the power of deliberate practice in developing trading consistency. They think that simply taking live trades over time will improve their skills, but this is like thinking you'll become a better golfer by playing rounds of golf without ever practicing your swing. Live trading is performance, not practice. You're executing under real financial pressure with real consequences. This is not the optimal environment for learning and skill development. Deliberate practice means breaking down the skill of trading into components and practicing those components in a low-stakes environment where you can focus on the process rather than the outcome. This might mean reviewing historical charts and marking where you would have entered and exited according to your strategy, then checking the results not to see if you would have made money, but to see if you correctly identified the setups. It might mean using a trading simulator where you execute your strategy without real money, focusing entirely on developing the habit of following your rules. It might mean reviewing your past trades and categorizing your mistakes, then creating specific drills to address your most common errors. The best traders spend far more time in deliberate practice than in live trading because they understand that the live market is where you execute the skills you've developed, not where you develop the skills in the first place. There's also tremendous value in understanding that trading mastery isn't a destination you reach, but a process you engage in continuously. Most traders are waiting for the moment when trading becomes easy, when they've finally figured it all out and can just execute perfectly without effort. That moment never comes. Even the most successful traders with decades of experience still face psychological challenges. They still feel fear during drawdowns. They still feel temptation to deviate from their strategy. The difference is that they've developed the awareness to notice these feelings and the systems to prevent these feelings from influencing their behavior. They're not succeeding because they've transcended human psychology. They're succeeding because they've built robust frameworks that work despite human psychology. This is actually liberating when you fully accept it, because you stop waiting for some future version of yourself who no longer struggles. You accept that struggle is part of the process, and you focus on building systems that work even when you're struggling. You stop seeing psychological difficulty as evidence that you're not cut out for trading, and start seeing it as the normal operating environment that everyone deals with. The final piece of this puzzle that ties everything together is the recognition that your trading strategy and your psychological capacity must be matched to each other. A strategy that requires you to hold positions through significant volatility is wrong for you if you don't have the psychological capacity to watch large, unrealized losses without panicking. A strategy that produces few signals might be wrong for you if you need frequent engagement to feel productive. A strategy that demands you trade during market opens might be wrong for you if you're not a morning person and your decision-making is poor during those hours. Most traders spend all their time trying to find the best strategy in abstract terms, as if there's some universal optimal approach. But the best strategy for you is the one that matches your psychological makeup, your schedule, your risk tolerance, and your capacity for uncertainty. A mediocre strategy that you can execute consistently will always outperform a theoretically superior strategy that you can't execute properly. This means you need to be honest with yourself about your strengths and limitations, and you need to design your trading approach around who you actually are rather than who you wish you were. This self-knowledge and self-acceptance is often the final barrier that traders must cross before they achieve genuine consistency. Once you stop fighting against your own nature and start working with it, trading transforms from a constant psychological battle into a process you can sustain indefinitely. That sustainability, more than any single brilliant trade or perfect strategy, is what creates long-term success in the markets. Here's what I want you to do right now, before you close this page and return to your charts. Take out a piece of paper or open a note on your phone and write down the last 5 trades you took, not just whether they won or lost, but the real story behind each one. Did you follow your strategy exactly as written, or did you make adjustments based on how you were feeling? Did you skip any valid setups because you were afraid after recent losses? Did you take any trades that didn't match your criteria because you were bored or trying to recover from a loss? Be brutally honest with yourself, because nobody else will ever see this. If you can't remember these details, that's your first problem right there. You're trading without awareness of your own behavior patterns. Next, I want you to commit to one single change for the next 30 days. Not 10 changes, not a complete overhaul of your trading, just one specific, measurable behavioral change that addresses your biggest psychological leak. Maybe it's implementing a mandatory 30-minute break after every loss before you can take another trade. Maybe it's reducing your position size by half until you can execute 10 consecutive trades without deviating from your strategy. Maybe it's creating a pre-trade checklist that you must complete before every single entry. Choose the one change that scares you the most, because that fear is probably pointing you toward exactly what you need to fix. Write it down, make it specific, and track your compliance every single day for 30 days. Finally, stop searching for the perfect strategy. If you have a trading approach with a positive expected value that you've tested over at least 100 trades, your strategy is good enough. Your problem isn't your strategy, it's your execution. Commit right now to giving your current approach at least 200 more trades with perfect execution before you change anything about the technical aspects. 200 trades where you follow every rule, where you track every deviation, where you measure yourself on a process rather than outcome. I guarantee that if you do this, you'll discover that your strategy was working all along. The breakthrough you've been searching for isn't in the next indicator or the next setup pattern, it's in the mirror. Take action on that truth today, and 6 months from now, you'll look back at this moment as the turning point in your trading career.